Ladies and gentlemen, good day and welcome to SRF Limited's Q2 and H1 FY24 earnings conference call hosted by Axis Capital Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the call, please signal an operator by pressing star and then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Ankur Periwal from Axis Capital Limited. Thank you, and over to you, sir.
Thank you, Gio, and good afternoon, everyone. Thank you for joining us on SRF Limited's Q2 and H1 FY24 results conference call. We have with us today Mr. Rahul Jain, President and CFO, SRF Limited. While we'll hear Rahul's thoughts on the results as well as outlook shortly, but before that, let me invite Ms. Nitika Dhawan, Head of Corporate Communication at SRF, to initiate the proceedings for the results call. Over to you, Nitika.
Good afternoon, everyone, and thank you for joining us on SRF Limited's Q2 and H1 FY24 results conference call. We will begin this call with brief opening remarks from our President and CFO, Mr. Rahul Jain, following which we will open the forum for an interactive question and answer session. Before we begin this call, I would like to point out that some statements made in this call may be forward-looking, and a disclaimer to this effect has been included in the earnings specifications shared with you earlier. I would now like to invite Mr. Jain to make his opening remarks.
Thank you, Nitika. Good afternoon, everyone, and thank you for joining us today on SRF's Q2 and H1 FY24 earnings conference call. I trust all of you have had the opportunity to go through the results presentation shared with you earlier. I will initiate the call by briefly taking you through the key highlights for the period under review, following which we will open the forum to have a Q&A session. We witnessed lower revenues and profitability during the quarter with both our chemicals and packaging films businesses facing headwinds. During the quarter, gross operating revenues declined 15% YOY to 3,177 crore. EBIT was lower by 23% YOY to 533 crore. Profit after tax came in at 301 crore in Q2 FY24, lower by 37% YOY. Coming to our segmental performance, in Q2 FY24, our chemicals business reported lower revenues of rupees 1,426 crore, down 22% YOY. Within the chemicals business, specialty chemicals witnessed subdued demand owing to ongoing destocking and inventory rationalization by customers for certain key products. And we believe that we have seen a large impact of the same in Q2 FY24. While we continue to encounter rescheduling of some orders, we have not witnessed any cancellations. We remain optimistic that Q3 would be better than Q2 and Q4 will witness more reasonable levels. Therefore, we firmly believe that H2 will be better than how H1 panned out. We also believe that fundamentally the business is in good shape, both on new products and capability. Cycles are a part and parcel of any business. In such a scenario, marginal growth is also a fairly good position to achieve. This is further supported by the cautiously optimistic outlook shared by major agrochemical companies for 2024. We are consistently expanding our product portfolio, having introduced 6 new products in H1, comprising of 4 in agro sector and 2 in pharma. Our pipeline for complex products and AIs also remains on track. Over the past few quarters, we have successfully commissioned flexible and dedicated facilities and are in the process of capitalizing projects close to 1,100 crores in the second half of this fiscal. Furthermore, the board announced a capex of rupees 235 crore for setting up a new and dedicated facility at Dahej for the production of an agrochemical intermediate. These initiatives signify our strong confidence in the segment's potential to create substantial value for all stakeholders as we work towards process improvements and increasing asset utilization levels in FY25. In our fluorochemicals business, we witnessed lower volumes and realizations in a seasonally weak quarter for the domestic market, as well as Chinese dumping, leading to lower revenues and profitability in Q2. In addition, the demand environment for some industrial chemicals remained subdued due to sluggish growth witnessed in agrochemicals and pharma industry. Having said that, in Q2, we achieved highest ever MDC domestic sales for a quarter with a significant increase in market share. Dymel also delivered steady performance and is now serving customers across 27 countries with a strong future growth potential. Q3 should witness demand uptick from domestic players as stocking for 2024 season begins, and Q4 should witness volume traction from US customers. As we transition into the second half of the year, our expectations are focused on several promising developments in the segment. We anticipate an uptick in pricing for HFCs, especially in the key markets like India, Middle East, South Asia, and United States. Industrial chemicals are also expected to perform better than H1, owing to higher demand and price expectation. Additionally, it is worth noting that our new HFC project should go online very soon, which will add to our capacity and allow us to cater to our key local and global customers. The company remains committed to prioritizing the commissioning and ramp-up of our ongoing projects. Here, I am pleased to share that we have now commissioned our PTFE plant. This project experienced delays due to challenges in obtaining support from our technology partners. In response to this, our internal teams proactively took the initiative and commissioned the project. This not only underscores the impressive R&D and engineering capabilities of our in-house team, but also highlights our self-reliance and adaptability to cater to tough situations. We believe that the product has received a positive response from some of our customers, both locally and internationally. While there will be some time for the product approvals to come in, say within the next 6 to 9 months, the ramp-up will be faster than what we had envisioned earlier. In our packaging films business, SRF reported a decline of 16% in revenues to rupees 1122 crore during the quarter. Some of the decline in the business revenues can be attributed to lower price of key raw materials and some to the oversupply situation in the industry. While the ongoing challenge owing to significant demand and supply mismatch continues, the business is actively focused on improving profitability through operational efficiency initiatives, expansion of value-added products in both BOPET and BOPP, implementation of cost-saving strategies, and securing additional contractual sales. I am happy to share that this quarter, the board has approved an investment of rupees 275 crore at Indore for establishing a dedicated capacitor-grade BOPP film line aimed at expanding in business adjacencies. This is our foray into manufacturing of higher value-added products to cater to demand emerging from manufacture of electronics and EV sector in India. A more detailed rationale for this is available in the presentation that has been uploaded to the stock exchanges. The aluminium foil facility is now in trial phase, with commercial production expected soon. The project is expected to be value accretive to the business as customers remain similar and demand strong. Overall, in this segment, market trends point to the persistent imbalance in demand and supply, particularly in BOPET, which is expected to impact performance for the next few quarters. SRF will continue to focus on value-added products and ramp up the aluminium foil project at a fast pace. Moving to our technical textiles business, we reported a steady performance. During Q2 FY24, SRF successfully completed the phased capacity enhancement project for its TCA value chain. Further, progress in the expansion project for belting fabrics and polyester industrial yarn remains on track. Market trends indicate a consistent growth in various vehicle segments, ensuring continued demand for nylon tire cord fabric. Additionally, the government's emphasis on infrastructure development is expected to drive increased demand for belting fabric and polyester industrial yarn. Lastly, in the other segment, imported fabrics, SRF attained all-time high domestic sales and EBITDA, primarily driven by strong demand for our products, including value-added products. SRF has been able to capture maximum share of the growth that has happened in the market, and the outlook suggests continued healthy demand in the near term. For laminated fabrics, SRF achieved record sales in H1, with the plant operating at full capacity. However, an oversupply situation persists, and SRF anticipates market challenges due to new capacity additions while expecting stable demand. Coming to our balance sheet, our net debt increased from roughly about 3,250 crores as on March 31, 2023 to about 3,900 crores as on 30th September 2023. This increase is primarily owing to our capex of around rupees 1,400 crore in H1. Additionally, we are also witnessing an impact of the increased interest rates both on the rupee and the US dollar borrowing, which is leading to higher interest costs being charged off to our P&L. Global interest rate cycles are now peaking out, and some positives should be witnessed on this account over the next 12 to 18 months. In our endeavor to achieve benchmark performance across functions, we were recognized with a slew of prestigious accolades in this quarter. We received the Best Corporate Cash Management Services and Best Corporate Technology Adaptation towards awards from HDFC Bank, highlighting our excellence in financial and technological domains. Additionally, SRF's technical textile business won the Metaxel Export Award for outstanding export performance for the year 22-23. On the social realm, SRF Foundation was honored with the Shiksha Bhushan Award at the 27th Bhamashah Samman program by the government of Rajasthan. Additionally, the SRF Foundation won CSR Times Award 2023 Gold for its rural education program and earned a certificate of appreciation under the Operational Kayakalp program by the government of Uttar Pradesh for development of infrastructure facilities in government schools. These accolades underscore SRF's commitment to excellence across various sectors. In conclusion, despite the challenges faced in various domestic and international markets, we maintain a positive outlook for the second half compared to our first half. While the near-term prospects for our packaging films business is weak, our overall optimism is primarily based on our core chemical business and a stable technical textiles business going forward. Over the years, we have developed a world-class infrastructure, nurtured exceptional R&D capabilities, and secured ample resources to invest in emerging opportunities across diverse chemical sectors, particularly in agro and pharma. While some sectors may encounter transient challenges, we hold strong confidence in our chemicals division, driven by our R&D breakthroughs, which we believe will consistently drive substantial growth and enduring value for all stakeholders. On that note, I conclude my remarks and would be glad to discuss any questions, comments, or suggestions that you may have. I would now like to ask the moderator to open the line for the Q&A session. Thank you very much.
Thank you. We will now begin with the question and answer session. Anyone who wishes to ask questions may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking questions. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Rohit Nagraj from Centrum Broking. Please go ahead.
Yeah, thanks for the opportunity. First question is on the specialty chemicals business. So you mentioned that Q3 will be better and Q4 probably would be better than that. This growth will be primarily driven from volumes, and whether it will be the incumbent business or the newer project that we have commissioned. Just like to understand a little color on that. Thank you.
So the way we look at it, Rohit, is the fact that there has been some volume negative that we saw in Q2. Now, when we are looking at it from that perspective, there is some pickup that is likely to happen. Some of the orders from the customers have kind of got delayed, and that's where the volume pickup we are talking about in Q3 and Q4 coming through. So that's the existing products. Also, you would remember that over the last, I think 6 months or about 12 months, major capital expenditures have been commissioned. My sense is it would probably, including the MPP and the PIP, be about 800-900 crores. So some of the positive and new products that we have also launched, that we've talked about also, should come through in Q3. but the majority of those would probably come in FY25. So that's how we would look at it, Rohit.
Sure. Thank you. So second question is just a view on the segment-wise CapEx for FY24 and 25.
Again, I don't think the position on that has changed, Rohit. I think FY24, our total CapEx, including land, is roughly likely to be about 2,900 to 3,000 crores. If that land does come through, which we are estimating to be in the range of about 450 crores, that would be the total CapEx. 80-85% of that CapEx would be chemicals business, and the balance would be others. So that's how it is still structured. I don't think that has changed even one bit.
And FY25 also would be similar in terms of the intensity will be 29,300 and proportion of 80-85% from the spectrum?
Absolutely, Rohit.
Sure. This is helpful. Thank you and best of luck, sir.
Thank you.
Thank you. The next question is from the line of Sanjesh Jain from ICICI Securities. Please go ahead.
Yeah, good afternoon, Rahulji. Thanks for taking the question. First, on the ref side, it's slightly backward looking, but just curious to understand. We were anticipating the stocking up in the US market, the HFCs ahead of the next phase down. It appears that really hasn't played out. Just wanted to understand, is it that Chinese are dumping more and the quota have been filled? What has caused this refilling kind of a benefit not playing out the way probably we would have anticipated?
So thanks, Sanjesh. I agree that it is a slightly backward-looking question, but the point to make is that yes, there was some expectations of let's say the US market panning out in Q1. That did not come through. But I think instead of looking at it from a backward perspective, we should look at it from a forward perspective. What I can certainly say is the order book seems to be in good shape from a Q4 perspective for the international sales, specifically US sales. Some of the very large customers that we have in the US, we've already kind of done ordering with them, or their orders have kind of been frozen for calendar 24 and for 25 as well. So I think that's in good shape. Why did that not happen in terms of what was going on? I think there were various dynamics with respect to Chinese that were playing out in the market despite whatever be the pricing situation. So a lot of dumping happening into even the US market during that time, which created that kind of a situation. I hope it answers that.
No, it's fairly clear. Just on the 24 and 25, and now the tie-up has happened, which gives us a much better visibility. Are the pricings are also done that, or it will be more dynamic and it's more volume kind of a tie-up? And
it is more a volume tie-up. Pricing ranges are also tied up, but unfortunately, I can't tell you anything beyond it.
Got it. So that's clear. On the R32 side, I think we anticipated to come in November, kind of a thing. Are we in line with that anticipation?
I think end of November or mid of December is when this will get done. It is now getting through to a technical completion position, and hopefully by mid of December we will be commissioning the 32 as well. Some delay, I agree, but I think it was more technical than anything else.
Got it. And on the specialty side, again, sorry to ask the similar line of question, but I think some of the guidances what we are seeing now incrementally coming in, the agrochemical side, at least it appears that the volume pressure can persist in the H2 as well. We are not anticipating any such risk as of now.
So again, Sanjay, to be very frank about it, on the volume side, we believe that there is some pressure, no doubt on it. But I've kind of articulated it out that in Q4 we should do better. There are some positives that we are looking at. Again, like I said, we have not seen any major order cancellations coming in. So we are fairly confident of a certain growth number, even in the specialty chemical business, even during FY24 as a whole. So I don't think in the current market there are many people guiding for a growth in specialty. I think we are probably fairly confident of a single-digit growth at least coming through in specialty chemical space.
The single-digit growth in the H2 we are talking, or for the full year 24?
Whole of FY24.
Whole of FY24. That's great. One last question on the PTFE side.
I think we'll have to come back in queue. Other people also have to ask questions.
I will come back in the queue. Thank you, Rahulji, and best of luck for the coming quarters.
Yeah.
Thank you very much. Before we take the next question, we request participants to please limit your questions to 2 per participant. We take the next question from the line of Chintan Modi from Haitong Securities. Please go ahead.
Yeah, hi sir, thank you. So with respect to ref gases...
Slightly louder, Chintan, can't hear you.
Yeah, sir, can you hear me now? Is it better?
Yes.
Okay. So with respect to ref gases and this quotas coming into place, can you tell, explain how the mix will change between R32, 125 and 134A? And what would be the total volume impact for us in US market?
To be very frank, Chintan, it's a position that will play out over a period of time. The way we look at it is that there will always be a GWP equivalence position in the US market that will play out. Now, as GWP equivalence plays out, I think more of 134A and 32 should start to proliferate more. But again, that also depends on the local market where production is there. So it's a position that we will also see how it plays out. Majority of the local players will start to shut down some of their and balance out some of their existing capacities. And based on that, they will do a quota positioning in terms of what the quota they have and how much do they want to buy from outside, import either from China or from India. The way it will probably work out is 125 starts to go away first, then it will be 134A and then 32. But I think it's a position that will probably get more visible during 25 and 26. 24 is probably more understood well.
Okay, sure. And with respect to power and fuel cost, can you share what was the savings on, say, on a Q-on-Q basis or a YOY basis in terms of per unit cost?
Sorry, Chintan, you will have to come back on that separately. I don't have the numbers right in front of me. It's a mix of various businesses that pans out. If you are looking at it only from a Dahej perspective, it could be different. If you are looking at it from a technical textiles business perspective, again, it could be different. We will have to relook at the numbers and come back to you on that. While coal prices have witnessed a positive impact in CPP operations, mainly due to low demand of coal in China and Europe, I don't have the exact unit by unit numbers.
Okay, sure. And lastly, on the capacitor grade films, is this more of an imported product currently, or there are suppliers in the domestic market today? And also, along with that, if you can explain a little bit of economics, like how it would be better than our existing films business.
So on the capacitor grade film, the first question that you have asked is there are existing players or not. There are a couple of existing players that have some capacities, not doing too well as such because of their other issues that are going on. What we believe is that this is a film that the requirement of which will continue to go up. India is going on and looking at electronics manufacturing in India. Therefore, the need for capacitor grade films is high. The demand is expected to grow at roughly about 10% per annum. The current people that are there in the businesses are not operating it very effectively, and therefore we believe we will have a very large play in the business. The demand stems from consumer electronics and energy storage systems, major ones, and EV chargers and other applications in that space. So that's our strategic rationale around it. We want to become a global opportunity to manufacture these in India, to become a credible alternative, not just to Indian producers, but international guys as well. So that's the way we are looking at it. There are a couple of Indian producers also.
Sir, how much is demand today? These capacitors?
Roughly speaking, the demand is about, let's say, 14,000, 15,000 tons.
Okay. Got it, sir.
Capacity at a rated is about 7,000 tons. Majority of this is still being imported.
Okay. Got it, sir. That was helpful, sir. Thank you.
Thank you.
Thank you. The next question is from Surya Patra from Phillip Capital. Please go ahead.
Yeah. Thanks for the opportunity, sir. Sir, my first question is on the this HFC. Now, since the quotas are set and all that, you have commented something on that. But in terms of the volume, any sense that if you can provide, sir? Because as it was earlier understood that the ban on Chinese supplies or Chinese dumping in the US.
There is no ban, Surya.
Ban in the sense, implied ban, I mean, the anti-dumping duty. So because of that, it was expected that people would be a bit protected from Chinese dumping in the US market. But now it looks like that is no longer the case. So if that is the case, if you can give some clarity about the volume progress that we would see in the calendar 24 based on the quota that has been set for our clients and all, so that would be helpful.
Like I said, Surya, the position that we are taking on this is with some of our large customers, we have already tied up volumes for calendar 24 to a certain extent for 25 as well. I think that should augur well for us. We are also looking at various refillers that have the quota in the US market to be able to supply to them in volumetric quantities. The way we are looking at is that by FY25 and exiting 25, our capacity on HFCs should probably be about 80-85% utilized in total. What mix, what time is something that the market position will play out on, based on which we have the ability to use our capacities appropriately. So that's how we're looking at it, Surya. To be able to give you a projected number on each of the gas separately is too detailed an exercise for me to be able to.
Correct. But when you are giving a view about 25 also, sir, so you are factoring the shift in the emerging market from HCFC to HFC? Or it is just from the...
Question. Repeat, please.
So, starting 2025, January, even in the emerging market, the phase down of HCFC that is scheduled, right? So that should boost the demand for HFCs in the emerging market.
No, the way we are looking at it is transition into 32, which is the 22 replacement, is already happened, mostly even on the emerging market side. So I don't think that has too much of an impact. Yes, the growth is going to be significant. The Indian market is going to be a large one. And therefore, if you remember, I had also talked about that the domestic market and this should become a larger market going forward. So that's something that will play out, Surya.
Okay.
But whether it is because of the shift happening, I don't think so, Surya.
Okay, sure, sir. So, for second question is on this PTFE project, sir. Since although it is coming with slight delay, but obviously that would have positioned you better in terms of the customer acquisition, in terms of the product approval and all that. So now about the ramp up of that project and in terms of the utilization, let's say by next year, any sense that you are sharing, sir?
Again, the way we are targeting this is the fact that for FY25, because the balance ones of FY24 will probably be for the approval processes coming through. For FY25, we should get to a decent capacity utilization. But I can tell you this, Surya, that from what we had envisioned when we had started this project, right, to a 3 to 4 year ramp-up timeline of the PTFE project, I think the ramp-up is going to be significantly faster than that. So hopefully in the next 2 years or so, so FY25 and FY26, it should be fully ramped up. Hopefully we can do this even earlier and move to specialty grades on this.
Okay.
So that's the target here, Surya.
And sir, just on the extension of this portfolio of PTFE, can you share something or you will take some time to share update about the additional products?
Portfolio means what?
The additional products, specialty fluoropolymers.
No. So we have already announced the project for specialty fluoropolymers, right? Which is PVDF, FEP and FKM, right?
Yes.
That's a 2-year project that is currently on. PVDF might see some delays given where our position on land is. but FEP, FKM are pretty much online, Surya.
Okay. Just one simple question, sir, about the new projects that was due to commission this year. So, whether it is whichever segment, ref gas, or it is the fluoro specialty and all that. So, I think there is some delay before compared to the kind of earlier timeline. Is it a kind of a planned, considering the kind of demand situation and this thing, or it is?
You're right to a certain extent when you say that there is some delay. But on the specialty chemical side, I would say the delay is largely due to some supply chain issues, some procuring of certain key, let's say, engineering components and those types. Not with respect to, let's say, delaying from a product or a timeline perspective, time to market perspective. So that's not the case. It's largely because some of the supply chain issues we faced during this period, which has led to a couple of months delay in some of the projects in the specialty chemical space. In the fluorochemicals, be it PTFE or the 32 projects, yes, there were delays. PTFE, the delay was largely due to the fact that there was difficulty in obtaining visas for our technology suppliers. That did not come through, so we had to commission it online. Our engineers did it, so that took some learning exercise around it. On 32, I think certain government approvals that were to come through took some more time than we expected, which has led to some delays around that. But again, I think we are not very significantly delayed on that side.
Yeah, okay. Sure, sir. Thank you, sir. Thank you. Wish you all the best.
Thank you. The next question is from the line of Arjun Khanna from Kotak Mahindra Asset Management. Please go ahead.
Thank you. Thank you, sir, for taking my question. The first question is on the spec chem side of it. So, in discussions with our clients, I understand offtake has been slightly lower, like you mentioned, given global circumstance. When we have our discussions, is there any negotiation or rethink in terms of pricing of these particular products, or that's a discussion that's not come up, given that they are giving profit warnings?
So, Arjun, whenever you discuss something of that sort with clients, there will always be pricing discussions that come through. The endeavor at our end is always look at what are the technological positions that we can change around them, how much can we produce from the existing facilities, how better to look at efficiencies so that we can protect margins. But without a doubt, there are some pricing pressures also that are there. The only good thing, Arjun, that I can say is that the basic theme with respect to, let's say, the customer thinking about their own supply chains and robustness of their supply chain, I think that has not shifted. That remains pretty much well in shape even today. So while there may be some off and on discussions that will keep happening, I don't think the basic theme underlying has changed, Arjun.
Sure. And in terms of the way we look at the spec chem piece, in terms of what ROS we would like to generate from it, even post these discussions, do you think that number needs to come down, or are we yet confident of the 20+% ROS that we are targeting?
So again, if you are looking at it from an FY24 perspective, may not be 100% there in terms of our, but I can still tell you the return on capital employed that we are generating is still beyond that number. Right? When we talk about the 20% plus number, I think the way we look at it in the very long term, what is the number that we are happy with? I don't think that position from our perspective has shifted any bit.
Sure. Perfect. Sir, my second question is just on the PTFE. While we talk of full ramp up in FY26, just want to understand, while we know what the rated capacity is, in terms of output, just on a base of commodity grade, what would be the output that's possible to generate from our current equipment?
Currently, I think it is about 5,000 tons. If I am right, give me just one sec, I'll look at it. PTFE, 5,000 tons. Yeah, rated capacity 5,000, about 90% you can get to. Again, it also depends on what kind of grade you are producing. So that's the way we look at it.
Sure. Wishing you all the best. Thank you.
Thank you. The next question is from the line of Nishant Shah from Emkay Global. Please go ahead.
Yeah. Hi, sir. Thank you for the opportunity. My basic question is on the PFB segment. What will be the percentage of the sales under the contract and spot in India versus outside India? That's the first question.
Contracted sales, India and outside India?
Yeah.
So roughly speaking, our overall contracted sales would be in the range of 60 to 70%, right? Which covers all our contracted positions, both locally and globally. Now, what is the difference between that in South Africa, Thailand, Hungary versus what is in India is a difficult position. I will have to look at those numbers separately.
Okay. And from the pricing point of view, what will be the difference when it comes to renewals?
No, I didn't get the question, Nishant.
So basically, what will be the pricing levels when it in the contract versus spot when it comes to a renewal point of it?
So that it can't be looked at it from that perspective, Nishant. Contracted positions that get created are also to a certain extent a formula-linked pricing that comes in. It is not based on a certain fixed price position that you create. So I don't think if you are looking at it from that perspective, that's the right way to look at it.
Okay. Okay. And my third question will be, when we say the packaging business is not doing well, going ahead, so what will be the impact on the competitors who are only doing the packaging business? Or what will be the impact on the ongoing concerns?
So, Nishant, to be very frank, I think when you look at Q1 numbers, which are now out in the market, if you look at those, you will find that SRF's performance, both on EBIT percentages, EBITDA margins, or return on capital employed also in the business, is probably much better than any of our international, local, or global competitors. So I would really say that SRF performs much better than some of our peers. Some of the peers also have businesses which are kind of combined businesses with lamination and others as well, which really does not give us the ability to analyze. But given our value-added product portfolio, we still believe that we are probably one of the best in the industry.
Okay, but do you see the big players will survive this down cycle and the small players are getting out of it? So basically a consolidation in the industry.
To be very frank, Nishant, there are a large number of players in the industry today. There will be some, let's say, consolidation that will happen in the industry at some point in time. When, where, why, that only time will tell.
Thank you. The next question is from the line of Rohit Sinha from Sunidhi Securities. Please go ahead.
Yeah, hello. Thank you for taking my question, sir. So one question is on the new capex on the BOPP side. So that this 275 crore kind of capex, what could be the asset?
Your voice is not clear. Could you repeat your question, please?
Yeah. So on this side, BOPP capex side, the new capex which we have announced. So just wanted to understand what would be the asset turn and the margin profile for this company. And then is it the same product which Expro India is making currently, or one which they have discontinued some time back? So
it's a completely new product, Rohit. It is not an existing product. It is a BOPP film, yes, but it is not, let's say, a BOPP 10.5 meter type of line that we have today. It's a completely different product. We believe it has the project's realistic IRR should range in the range of about 16 to 18%. That's how we are looking at it. The way we look at it is roughly a payback period of about 5.5 years should come through, and it should be value accretive going forward. Also, I think it is from the perspective that it is a film that will get required in India's requirements of electronics manufacturing, which is growing. Be it in the EV side or the battery side, that's something that will need some of this film and maybe certain other specialized films that go on in future. So it's a foray into that segment where we think it will add to value from let's say entering into those high growth segments.
Okay. So just on the margin side, would be fairly fair enough to say that it would be slightly the northern side of the current normal VOPP and BOPET side?
Look at it from where current pricing is, certainly should be, but we've seen differential pricing. So on an overall basis, it should be more accretive than, let's say, a BOPP position today. But then margin should be really better than, let's say, the current BOPP state.
Okay. And just on the aluminum foil business, what is the status right now there, and when should we...
I talked about it. It is under commercialization. It is under final, let's say, installations. Hopefully, by the end of November, early December, we should see capitalization of the project and commercialization as well.
Okay. That is from my side. Thank you.
Thank you.
Thank you. Before we take the next question, in order that the management is able to address questions from all participants in the conference, we request participants to please limit the questions to 2 per participant. The next question is from the line of Keyur Pandya from ICICI Prudential Life Insurance. Please go ahead.
Thank you. So I just want to understand just a clarification. So the presentation mentions about the outlook that the current inventory rationalization may last for 2 more quarters related to specialty chemicals. And in your comments you mentioned that probably H2 would be better, or Q4 should see better growth and overall growth for specialty chemical as a product segment. So just if you can just clarify better on the specialty chemical, that would be helpful.
So Keyur, I think I was fairly clear in my communication. Q3 should be better than Q2. Q4 should be better than Q3. Overall, from an H2 perspective, we will do better than H1 in the specialty chemical business. Also, when you look at it from an annualized perspective, comparing FY23 to FY24, I said even despite whatever has happened in H1, we believe we should be able to grow the business in single-digit numbers on a revenue perspective. So that's the position that I had made. If that's unclear, please let me know.
Perfect, clear. And when you say that a single-digit growth, that is for specialty chemical, right? Not for the chemical segment as a whole.
Yes, please.
Okay, thank you. I'll get back in the queue. All the best.
Thank you very much. The next question is from the line of Rohan Gupta from Nuvama. Please go ahead.
Rahul sir, good evening and thanks for the opportunity. Sir, first question is on our confidence which we still have that in specialty chemicals with the year end FY24 we still will be able to end in a positive number. This is primarily driven by the 4 new agrochemicals and 2 pharma intermediates which we have launched. If we adjust for that, do you see that there could have been degrowth, or what is the growth contribution coming from these 6 new products launched?
Okay, so the 6 new products are only where the, let's say, commercial quantities have been sent to the customer. These have not been factored into the numbers that I have been talking about. They are very small today.
Okay, so this is basically...
I said that we've launched 6 new products, 4 in pharma, 2 in agro. 4 in agro, 2 in pharma, right? But
yes.
I have not factored in any revenue positioning of those products in the number that I am talking on an overall perspective. Those will probably come out much later in time.
Okay, so the growth trajectory which we are still confident about in specialty is primarily coming from that the inventory rationalization is broadly over. However, we still see that many global companies are still giving profit warnings, and for the calendar year they are still talking about a degrowth scenario. So, I mean, there may be some kind of disconnect what these global companies are talking right now for Q3, what we are looking in a Q3 growth.
Again, no, I can talk about my positions, right? This is the positions that we are taking on this are in discussions with some of our key customers. Some of the order positions that they have talked to us about in terms of just delaying the orders. They've in fact talked about multiple new agrochemical intermediates also, which are kind of not factoring into this. You've seen us talk about a new investment of 235 crores in a new product. We'll probably get to over 600 metric ton of that product. It is also a product that can in the future become a new AI that we believe we can do for the customer. So all of this is based on our customer discussions, our order book, and our positions going forward. Specifically, to be able to answer what the customer is talking about in generic, very difficult. But my commentary is largely on the basis of what we are seeing and discussing with the customer.
That's very good, sir. So the second question is on our CapEx. We have commissioned roughly 1,100 crores so far in H2. We initially guided for roughly 2,400 crores plus kind of in chemicals, and overall CapEx guidance was some 3,000 crores plus. So what is the number? What is the CapEx outlook right now? Have we revised that?
So for FY24, I believe we will still get to that 3,000 crore number subject to the land. For FY25, I think again the guidance of let's say 2,800 to 3,000 crore remains, with the new projects also in parallel starting to get let's say established and money spent on that. I think we should be in fairly good shape to get to that number. Again, the basic criteria of that as 80% chemical business still remains wrong.
Thank you very much, sir. Thanks.
Thank you. The next question is from the line of Abhijit Akela from Kotak Securities. Please go ahead.
Yeah, good afternoon, Rahulji. Thanks so much for taking my questions. Just a couple on the chemical segment. First, on the segment margins, they've come down a little bit this quarter to about 24.4 at the EBIT level. I understand this is probably to do with operating leverage and maybe a little bit of pricing pressure. But how should we sort of think about these margins? Can they sort of trend back towards the older levels of last year or so in the next few quarters?
So again, Abhijit, what I had said in the past also is that in one of the quarters we've seen a margin of 35%, EBIT margin, right? We had said that that's not a sustainable position. Right? Given our position on this, we had said that on an annualized basis, margins ranging between, let's say in the range of about 26 to 30% range should be something that we should be able to achieve. Again, to be very frank about it, we don't look at it on a quarter-on-quarter basis. I think it is best to look at it on an annualized basis. This quarter, what you've seen as margins are probably in the range of about 24.5%. Even when you look at it from an H1 perspective, we were probably about 26%. So I think we are fairly well within that range that we've spoken about. It's business, Abhijit, and to be very frank about it, is not linear. It will have its ups and downs. What I'm kind of telling you is that there is conviction on CapEx, there is conviction in terms of order book that we have, and that's in fairly good shape. So that's how we look at it, Abhijit. Not really a quarter-on-quarter position that we look at.
Right, sure. Understood. Thank you. And the other question was just on the revenue side. Would it be possible to share the specialty chemicals growth for the first half? I know in 1Q you had mentioned plus.
Unfortunately, that remains where it is. Only annual basis we will be able to give you the numbers around it. But let's say, like when we were talking about it on Q1 perspective, where we had said that it is grown significantly. On an H1 perspective, the growth is probably not as much. It is probably flat to slight negative.
Okay, got it. Great, sir. And one last thing from my side. You did speak about the expectation of enhanced pricing in the fluorochemicals business next year. So again, if you could give us some sense of what sort of price increases we could expect potentially next year.
Too early, Abhijit, to be able to answer that.
Okay, fair enough, sir. Thank you so much. All the best.
Thank you. The next question is from Archit Joshi from B&K Securities. Please go ahead.
Hi, sir. Thanks for the opportunity. Sir, I just have one on some global issues. In your conversations, if you can help us explain the way the business has been carried out on the inventory front. What we are made to understand that the MNCs were holding, let's say, 4 to 6 months of inventory in the last 2-3 years, looking at strong demand on the farm side, wherein our growth were also quite strong. And certain macro conditions have sort of created this inventory snowball, due to which our growth also has been impacted. So I was just trying to understand if there is any correlation with the level of inventory that our customers or MNCs were holding. And let's say that in the ensuing quarters, maybe the next year when the base is normal, if they shift back to inventories which are lower than what they were last 2 to 3 years ago, maybe when the growth was quite strong, would that have an impact on our growth also in FY25?
Archit, to be very frank about it, I think you are answering the question yourself. You are absolutely right that there was a position on this that was being created because of the fact that post-COVID, some of the supply chain issues have eased out. And again, I think one of the larger issues here is also the fact that interest rate cycles globally have gone up very, very significantly over the last, let's say, year or so. Right? When we look at it, I think the cost of holding inventory has become dearer. Because of that, some of the customers are facing working capital pressure, which is therefore leading to let's say, delaying of some of the orders. Also, what has happened is because of the fact that supply chain issues that were there in terms of delivery ability, cost of the container, shipping material out, availability of containers, I think that has kind of eased out very significantly. And therefore, people are saying that it is important to be able to keep it like that and keep a lower inventory because, again, it boils down to the cost of carrying the inventory. Now, whether it has gone to 180 days or 270 days and it has now come to 30 days or 60 days, I really don't know, Archit. That's something that is very, very different for each customer, each position that he is taking. Very difficult to be able to comment on where the inventory levels are today. It's just a position that some of the customers are talking to us about, and we are seeing that kind of a delay happening when we talk to the customer. So that's where it is, Archit.
Sure, sir. Understood. Thanks for the clarification. All the best.
Thank you.
Thank you. The next question is from the line of Bhaskar Chakrabarty from Jefferies. Please go ahead.
Hi, good evening, Rahulji. One question on the specialty chemicals. The recovery in demand that you are seeing from your customers over the second half of the fiscal, is it mainly driven by 2 to 3 products, key products, or is it more broad-based?
So, to be very frank, Bhaskar, I have said it in the earlier part of this conversation also, that we believe that some of the key products that we have seen a lower demand and orders getting kind of shifted out to Q3, Q4. That's where we are saying that some of these will come back in. Some of the new product launches that have happened over last year and the plants that have got commercialized will also give in, let's say, from a revenue perspective and volumes perspective. But majority of that is not from, let's say, the new product launches that we have talked about. That's something that will come in over Q3, Q4. BASF has roughly spent Q3 and Q4, and Syngenta is probably more towards Q4. So that's how the global commentaries read out.
Sure, sir. Thank you. And this last question is that in some of the other players' cases, we have seen that they have indicated that customers have sometimes come back and asked for higher volumes, but then after a little while, they have again toned it down, and then again they have changed. I mean, the volatility in their assessment of their own demand has been very high. Have you also seen that, or you are seeing a betterment in that predictability?
Depends on customer to customer. To be very frank about it, I don't think it is generic in nature for me to be able to comment like that.
Okay. Thank you very much, sir.
Okay.
Thank you. The next question is from the line of Yash Shah from Investec. Please go ahead.
Hi, sir. Thank you for the opportunity. So I had 2 quick questions. The first question was regarding on the PTFE side. We were expecting to sell around... Yes, PTFE.
Slightly louder.
Okay. So, sir, we were expecting to sell somewhere around 1,000 to 1,500 tons of PTFE in the current financial year. Since the project has been delayed by a couple of months, so what is our revised expectation now that we'll be able to sell on the PTFE side?
Yes, I don't think I ever said that we will expect 1,000 to 1,500 tons in FY24. I never said that. Maybe that was your expectation. The way we are looking at it is that some of the sales, probably about 100, 150 tons per month, should come through in Q4 FY24, and the full ramp up probably by end of exiting FY25 is what we will look at.
Okay. Okay, fair enough, sir. And the second question was on the technical textile business. During first half, we were expecting pressure because of the lower caprolactam prices. Since the prices have started holding up, in fact, have increased starting September, can we expect better revenue on the technical textile business in the second half, sir?
Even if the prices go up 30%, revenue could go up 30%. It doesn't really matter, Yash, because at the end of the day, majority of the caprolactam, be it on a dollar margin basis or a rupee margin basis, is a pass-through. It could be a 30-day pass-through or it could be a 45-day pass-through depending upon the pricing methodology. But how does it make a difference?
Okay, fair. Got it, sir. Thank you. Thank you for answering.
Thank you. The next question is from the line of Madhav Marda from FIL. Please go ahead.
Hi, sir. Good afternoon. Thank you so much for your time once again. I just wanted to understand a bit on the pharma ramp-up. I think you did mention the PPT about some pickup expected. So by when do we, is it more Q3, Q4, or how do we expect that to pick up?
We are talking about the pharma ramp-up in a specialty chemical space.
Yeah, that's right. That's right.
So, Madhav, to be very frank about it, I think the agro traction has remained strong. Pharma PIP plant should pick up in, let's say, more towards Q4. There are products that have already been sent out for let's say, as qualification lots. 3 or 4 products have already been produced in the PIP, and I certainly believe that the full revenue potential will get realized more in FY25.
Okay, understood. And what is the gross block in the pharma PIP projects?
No, I have not broken it down as such.
Okay, got it. All right, thank you.
Thank you. The next question is from the line of Nitin Agarwal from DAM Capital. Please go ahead.
Thank you for taking my question. Sir, on the fluorochemical business, when you look through in FY25-26, do you broadly stay with the volume assumption assumption that you would have had earlier?
Sorry, Nitin, could you just go a bit slower? I have been unable to gauge your question.
On the fluorochemical business, fluoro specialty business, do we, when you look through the FY25-26 sort of broad volume estimates for our projections for ourselves, are we largely hopeful of maintaining the similar, doing the similar volumes as you would have probably thought earlier, despite whatever happened this year?
Fluoro specialty you are talking?
Yes, sir. So I mean the ref gas business, the fluorochemical business.
So ref gas business. See, again, I think the way our plants have come up and the 32 plants should get commercialized, I think we are in fairly good shape. Given where current revenue positions are, given where current margins are, even then I think the IRRs are probably better off than what they were when we had initially envisaged the project. So we are probably in better shape than worse shape.
And sir, in terms of the dynamics of the industry, has anything changed? Barring the with respect to the Chinese dumping and all of that has really happened, which structurally changes maybe some of your assumptions.
So not really, to a certain extent. The change in assumption is that, let's say, another player wants to come up as capacity. Some capacity has come up. There has been some rationalization that has happened on that. US quota positions are now frozen and will play out from January of 24 onwards. So all of those have happened. But again, I don't think it has made us think about, let's say, shifting some of the positions that we are taking on the business. Those remain in fairly good shape and going forward also positive.
Lastly, if you can squeeze in. So on the fluoro specialty part, this year you said it's a single-digit growth business. In the past, we've grown at an extremely strong growth rate in this.
I think you are misreading it, Nitin. I never said that it is a single-digit growth business. I have said that this year, even if we get to a single-digit growth position on the fluoro specialty side, given where the market dynamics are, I think it is much better than, let's say, growing 40% last year. That's what I have said. So please read it properly. I am not saying that it is a single-digit growth business going forward. For FY25, FY26 and onwards, given our capex intensity around it, we still believe a 20% plus growth is still possible.
Okay, that's what I want to say. Thank you, sir.
Thank you. The next question is from Krishnan Parwani from JM Financial. Please go ahead.
Yeah. Hi, Rahulji. Thank you for taking my question. Just two small clarifications. So the first clarification, I'm not sure if I heard it correctly, but did you mention that your HFC volume for CY24 for US market is tied up, or did I hear something wrong?
I said calendar 24 for some of our key customers, not the full one.
Okay. Some of your key customers, the volume is tied up. Yeah. So, okay.
It's very encouraging, Krishan.
Yeah. I mean, yeah, that's why I needed the clarification. Yeah, that's pretty good. And the second clarification, or rather a question rather, it is, so you highlighted single digit volume growth revenue growth for specialty business in FY24. Just wanted to check whether you have any kind of guidance on the fluorochemical side for FY24.
Again, I think the way we've always looked at it, volumetric position, given where the 32 will come up, given where US demand positions are, given where, let's say, PTFE should kick in to a certain extent, given where pricing expectations are, even if we could get to a flat number as to last year, we should, I think, be in very, very good shape. But I think as of now, it looks a bit difficult.
Okay, no problem.
Pricing is down, to be very frank.
Okay, understood. Thank you for these clarifications and wish you all the best. Thank you so much.
Thank you.
Thank you. The next question is from the line of Vishnu Kumar from Avendus Spark. Please go ahead.
Yeah, thanks for your time, sir. Specifically on the ref gas volumes that you mentioned on, in terms of US, the expectation would be for 24, would it be higher than 23, or how should we look at it?
No, could you repeat question, Vishnu?
So for the volumes contracted, or rather, your expectation for 24, the volumes that you might export to US, would that number
Calendar
be?
24.
Yes, sir. Correct.
So when you look at calendar 24 versus calendar 23,
yeah,
which would then be a good comparison to make, I think our endeavor is to sell higher in the US market. While some of that has got tied up, it will take a lot of effort to be able to do that. I think we should be able to achieve it.
But this will be more towards 32 than 34.
See, again, then I will also have to tell you what volumes are of 125, what is the position that I am taking with each of the customers, that I don't want to do.
Understood, sir. Sir, also, when you say that your EBIT margin medium term, you would want to keep it between 26 to 30, what would be the pecking order between the ref and the chemical business, which would be higher, lower, and any risk that you see to these numbers?
Sorry, Vishnu, your voice is kind of not appropriately coming. Could you repeat that question, please?
Yeah. So when you say that the EBIT margin range that we want to keep it between 26 to 30%, which segment, whether the ref for, in terms of pecking order, which one will be higher, the ref and the the specialty business, and if there's a volatility or a higher risk, which one of these businesses would be that?
On a ROCE basis, again, let's say on an EBIT margin basis, it really depends on how each of the business segments is playing out. It is not always true to say that a specialty chemicals business will always be at 5 percentage points higher than fluorochemicals business. On a generic basis, we believe specialty chemicals on a long-term basis should give us higher ROCEs compared to fluorochemicals business. But when you look at it on a positional basis, for 1 quarter, 1 year, depending upon where markets are, the positions could be different. FCB could be going through a boom, while specialty could be doing a stable positioning. So it really does depend on what is the position on that side. If you take 5-year averages, I think specialty should be higher.
Understood, sir. Thanks, sir. All the best, sir.
Thank you. The next question is from Mr. Jason Soans from IDBI Capital. Please go ahead.
Yeah, thanks for taking my question, sir. So just a simple question I had in terms of our intermediates which go into agrochem and pharma. Just wanted to know from a ballpark perspective, what percentage of that goes into patented molecules and what percentage of that into generic?
Unfortunately, that's something that we can't track. There are products that go into both. Because these are not AIs in nature, it is impossible to be able to say.
Okay, sure, sir. Okay. And sir, my next question is, what percentage of our specialty chemical business is contracted is contracted basically?
almost 90% of the business, 95% of the business is contracted. Some are 2-year contracts, some are 3-year contracts, some would be 1-year contracts also, some in 6 months order-based contracts also, but majority of it is contracted.
90% is contracted. Sure. So, just in a follow-up to that, I just wanted to ask, just last 6 months, this Chinese dumping has started and this intensity has come through in a large way. So in terms of these already established contracts, already made contracts, do you see any structural changes to the contracts? Of course, there'll be some de-escalation, raw material prices coming down. Do you see any structural changes to this contract?
There may be some other, let's say, positions that the customers would like to create. But I think again, you have to understand that the global theme that is playing out is de-risking. Right? So while there may be some, let's say, positional play that will play out, globally the de-risking theme continues, which is what we said, I think in the earlier commentary also. Which therefore means that when we look at it, while there may be a contract-to-contract position that plays out, if we are setting up facilities for a customer, we will want to see, let's say, more longer-term contracts coming through. Again, we've been very flexible with the customers in terms of getting better positions with them, getting newer products, more complex products, which has helped us in time for us being able to get, let's say, better shares from customers. So that's how we look at it.
Sure, sir. So, but here and again, what happens is the de-risking is a vis-a-vis against cost competitiveness. So that was the only sense of asking that.
To be very frank about it, the customer would want to buy from me at a Chinese price, if that's possible, right? But
right.
Is the debate that will always keep happening.
Right, sir. Yes, and we have to match that. And just one final question from my side.
No, I've never said that we have to match that. I'm saying we will always have to look at the economics of the position that works out in a manner that can be profitable growth for us.
Right, sir. And so just one final question from my side in terms of HFCs. If you could give us a revenue contribution from major geographies, you mentioned key markets such as US, Middle East, India, if we could get.
Well, so I don't want to give from a geography perspective, but let's say exports is about 60% of HFCs and the balance would be domestic, 60-65%.
Okay. Thank you so much, sir. Thank you so much.
Thank you.
Thank you very much. We'll have to take that as the last question. I would now like to hand the conference back to Mr. Rahul Jain for closing comments.
Thanks, everyone. I hope we have been able to answer, if not all, some of your questions. I hope that each one of you continue to remain safe and healthy. If you have any further questions, we would be happy to be of assistance. We hope to have your valuable support on a continued basis as we move ahead. On behalf of the management, I once again thank you for taking the time to join us on this call. Bye-bye.
Thank you very much. On behalf of Axis Capital Limited, that concludes the conference. Thank you for joining us, ladies and gentlemen. You may now disconnect your lines.